Thank you for joining with us again on a Friday evening for our weekly show, Ab India Karega Invest, where every week we bring to you an interesting topic related to your investments. I am Rishabh Lunia from Novice Learning Academy, and today the topic is sectors to watch in 2021. Now, I'm sure after last few days, you would be thinking whether IT makes a sense to invest in your portfolio because two major IT majors have got very good return, or seeing the increase in COVID cases, a lot of people might be thinking, is it a good time to again bet on pharma like last year? So all these questions which you have will be answered in today's topic, which I mentioned, sectors to watch in 2021. And to take on the topic, I have with me an interesting personality and a very seasoned fund manager, Mr. Chandraprakash Padiyar, Senior Fund Manager from Tata Mutual Fund. And alongside him, we have Mr. Shikhar, who will take us through the Groww platform. So the flow of the program will be, I'll quickly talk on some basics on sectoral investing, and then I will hand it over to Mr. Chandraprakash, who will give more insights on key sectors to look out for this year. And then we will hear from Shikhar, who will talk on the Groww platform. So quickly, I'll go ahead and share my screen. Now, if you remember, I think a lot of young viewers are there with us who may not be investing back in 2007, but I would like to just take you through some important pieces from history. 2007, we saw utility sector giving more than 150% return in one calendar year. Then came 2009, when FMCG topped the chart. If you remember, 2008 was a year when market crashed more than 50%, and FMCG topped the chart, which also gave negative return, but only 14%. So with minus 14%, FMCG was the topmost sector of 2008. And come 2009, we saw metal as a sector giving more than 200% return in one calendar year. But if you have just seen past year's performance and you just jumped into that sector, it is not so easy because subsequent years, those sectors have not performed that well. Then what is the strategy? What we should follow? I would just like you to show some key numbers from history, and from there we'll try to make some strategy which all of us can follow while investing into key sectors. So from 2006 to 2020, we have taken 15 years past data to understand which sectors have done better in comparison to our markets. So if you see, we have taken about 18 odd sectors, and there are about 8 sectors who have done relatively better. And in terms of market, we have taken BSE Sensex as the market indicator. So if you look at Sensex have given 11.68 KEGAR return, which is the average return for last 15 years have been 11 and a half or slightly more than that. And consumer durables, FMCG, banking, healthcare, these are the sectors which have done better. So they have given us an alpha of 3 to 4%. And if you look at consumer durable, almost about 5% higher than the Sensex. So these are the top performing sectors. But at the same time, you might be getting a question in mind that are there any sectors which have underperformed the market during the same period? Yes, there are. So quickly, we will look at some underperforming sectors which have not done all that great during this long-term period of 15 odd years. So what are those sectors? So some of the sectors which have highly underperformed are utilities, metal, power. Now, having said that, we have seen a 15-year performance where the average return has been very low. But these sectors have been real performers. As I mentioned, in 2009, metal has given 200%. So there are some phases of outperformance. So if you were lucky and if you had put metals in 2009 and you could exit on time, you would have seen metals giving good return to your portfolio. But stock picking or sector picking is an important skill. If you couldn't pick them on time and if you remain invested for a longer period of time, even with 15 years of investment, you see some of the sectors have actually pulled your performance down in your portfolio. So seeing these two charts, though it is very important to pick the right sectors in our portfolio, but at the same time, it is also very important that we don't get fixed in some underperforming sectors. Now, this is talking about returns, but very, very important when we talk from investment point of view, we don't only look at one side of the coin, but we need to also figure out what lies on the other side. And that is something which we call as risk in our investment terms. And we define that risk in terms of standard deviation. Just to explain you in simple language, stocks or sectors which are more volatile will have higher standard deviation. So standard deviation is a tool which fund managers use to find out which sectors have more risk, which sectors have less risk. And if you see clearly, metal as a sector has the highest standard deviation during this 15-year period. And if I talk about FMCG, which has the lowest, which about 16.94. So when we are doing sector selection, not only returns, but we need to keep in mind how much risk these sectors are taking. So risk adjusted basis, if your sectors are doing good, well, that should be an ideal strategy when you're looking from investment point of view. Now, is there any trend is there any pattern which we can follow? Can we connect these dots? How do we make sure that we are not getting fixed in those underperforming sectors? And how can we identify those top performing sectors? So what's the process? So if you look at any fund manager or broadly the fund management teams, generally they follow a top-down approach where they go about doing the economy analysis, that how the country's economic condition is. And while doing that, they look at GDP numbers, they look at all the inflation numbers. And once they are comfortable that the economic condition is conducive, then they go and do the industry analysis or the sector analysis. Once they have identified sectors, then they go and identify good companies in that sector. So broadly, this is the whole process which most of the fund house follow as an investment process. And when they are doing economic analysis, another important thing to understand here is which economic phase the country is currently going through also makes a lot of difference, because your sector selection and your stock selection has to go hand in hand with the economic phase which is currently going on. Now, if you remember 2008, we saw a depression or a recession globally, but in India, it was a slowdown. Then in 2013, we saw financial crisis. And again in 2020, which was a classic example, because we saw recession where we saw 2 quarters GDP negative returns. And we also saw a steep recovery happening in the same year. So once you know which phase you're going in, then the process becomes really, really easy. So is there a trend which we can follow? So what I will quickly take you through is there are 4 broad market cycles which we call as the rebound or the recovery phase, the peak, the moderates or when the market is slowing down, and then the contraction or the recession. So if you look at currently, if we feel that, okay, we are in the rebound zone, we have seen last year markets going down and we are doing a recovery. Generally in rebounds, financial, real estate, consumer discretionary, all these sectors tend to do good. And if I talk about recessions, I think we have seen consumer staples, consumer durable, FMCG, healthcare, these whom we call as defensives, they tend to do very good during this phase. So understanding of this economic cycle is very important, and then understanding of which sector tend to do good. See, this is on a broader level, again, depending on circumstances, because there are so many other factors which Mr. Chandraprakash will also take you through. We need to keep in mind, but broadly, when you are doing sector analysis, these are some of the things you need to keep in mind. But I would also like to reiterate one important aspect of your portfolio making, that you need to have your portfolio diversified. So core and satellite, as you would have heard in our previous programs also, is a trusted way of making your portfolio, where 60 to 70% of your portfolio could be core, and the balance 30% you can have your satellite component. And sectoral funds, if you're looking to invest, can be part of your satellite portfolio. Whereas your depending on your age and depending on your other factors, your large cap diversified funds or your index funds makes more sense in your core portfolio. So having said that, I would like to call Mr. Chandraprakash, who will take us through what are those important sectors to watch out for this for this coming financial year. Yes, I'll just close my share. Yeah, over to you, Mr. Chandraprakash.
Sure. Thank you, Rishabh, and good evening to all, and thank you for joining us for this webinar today. Let me just share my screen, and then we can quickly start on the presentation. We are ready to, okay. So thank you once again for joining on this webinar. I will, as Rishabh was explaining the views on sectors and trends and in the market, and which sectors can do well, which sectors have performed in the historical period, and what can happen in future. I'll try and give our perspective, which is Tata Mutual Fund perspective on the markets and sectors per se. So let me start. Before I go to the sectors, I wanted to give you a brief view on, or set the base on why we believe which sectors will perform in future. And that is why it is important that I take you through our view on the economy, markets, what is likely to take place going forward, and that will help us kind of conclude on which sectors or which kind of businesses can do well going forward, and investors can then choose. As Rishabh rightly said, stock selection is the key in the markets for making good money or making higher returns in future. So it comes from, you can either do a bottom-up stock selection, or also go top-down and then choose your stocks. So let's start with the market view. It's been I want to start with a slight history, in the sense that it's been now 11 years or 12 years of a very low corporate earning growth in India. 2008, FY 08-09 was the last financial year in India where corporate earnings grew at double digits. Post which there were a few, 1 year, FY 12 probably, where corporate earning grew by in double digit, but largely we have been in low single digits in terms of, for example, last 11, 12 years or 13 years, average profit growth for Nifty Sensex companies has been something like 4.5% CAGR. And our average Nifty Sensex returns has been something like 6.5% CAGR. So it's been, as you can notice, average your returns in the markets, or let me put it this way, stock prices are a function of what kind of profit growth, sustainable profit growth can companies deliver over year after year. Historically, we've seen, for example, when I started my career, I started in 2000. So it's now 21 years, close to 21 years. And in the last 21 years, the average profit growth for Sensex Nifty companies has grown something like 11.5-12% CAGR. And returns for investors has also been something like 13 to 14% CAGR. What it tells you, and I gave you an example of 13 years, returns follow profit growth, sustainable profit growth year after year. Obviously, you need to choose the right business. I'm just giving you a normal average Nifty Sensex performance. But the important point is that if companies do well, if profit growth is better, then returns will follow. It may not be exactly linear, but that's a correlation is very high. Why I say this, or why I'm kind of starting with this point, is that starting FY21 and FY21, the year that just about ended in March, which was a COVID year, for example, between March of 2020 and June, July of 2020, which is or April to July, which is the first quarter and partially second quarter of FY21. There was lockdown because of COVID, nationwide lockdown. All businesses were shut down, and it is in that phase where companies, and it is in that phase that FY21, the year that has just ended, results are going on. But our view is that profit growth or consensus view in the market is something like 12 to 14% profit growth in FY21. That's a very healthy number in a year where there was COVID-induced lockdowns. So we believe this is the start of the phase. We are in the early cycle, as Rishabh explained, early cycle, late cycle, and those cyclical or in terms of market phases. We believe we are in an early cycle of earnings rebound, economic rebound, where demand normalization is just about taking place right now on a low base of FY20. And FY21 is expected to be a very strong year, but equally stronger FY22, the year in which we are right now, and the year after, which is FY23. The next 2 years looks like, that's Bloomberg consensus estimate that I'm highlighting. The average profit growth is going to be something like 18.5%, 19% CAGR for the next few years. In fact, FY22, the current year profit growth consensus expectation is something like 40% plus on a base of FY21. So profit growth is likely to be very strong. In fact, it's in my experience of last 21 years, we are in a scenario where, at least for the first time, I am seeing this, where whichever company that I look at or I meet, management teams I listen to, either in AGMs or analyst meets or in their interviews on media, every company, and you would probably notice this too, every company today or every management team today is talking of delivering high return on capital employed. This has never happened in India in the past. In this stage, in this phase, all managements are realizing the importance of generating higher return on the capital that they invest in their business. What they also realize is that if you can generate higher return on capital employed, then what it also means that your balance sheets are stronger, which means that your debt to equity is very low. Your business generates free cash, which can be reinvested to grow sustainably in the long term. And hence, this learning or this phase of management's realizing that just growth is not important. You need to generate better profitability, better focus on balance sheet, free cash flow. And hence, equity markets are rewarding companies in a strong manner in the last 12 months. So as you would generally, you would have heard this phrase that equity market generally are early or kind of price in earlier than the actual event happens. So FY21, equity markets have done extremely well. Some sectors have done more than others, but generally speaking, markets have done very well. And this is on the back of expecting better performance from corporate India. And as I said, we are also expecting that. So the first point that I want to start with is that we believe the next few years, profit growth from corporate India is likely to be a fairly strong healthy, strong double-digit trajectory, which was last seen between 2003 to 2008 in India. And we all know what happened in India in that phase, where corporate earnings were growing at 24% CAGR, and market returns were also something like 25, 26% CAGR. So that's the first point. The second point, which is very interesting, because we were post-financial crisis in 2008, Indian corporate were sitting on very high balance sheet debt. Sectors like power, steel, textiles, all those sectors had invested aggressively in that phase. And what they realized after financial crisis in 2008, that you did not need so much of capacity. And resultant impact was that most of our Indian banks saw, at least the PSU for sure, and some private banks, saw high NPAs, and for which recognition started happening from 2013 to 2018. But that's the impact of overinvestment that happened between 2004 and 2008. So over the last 11, 12 years, we have not seen private capex, or in fact, we have seen private capex deteriorating, or the pace of investments reducing year after year. There were issues on road sector as well, land acquisition issues, pollution issues, all of those issues came in. Net impact was that private capex was close to very negligible levels. This, as I've written here, we believe private capex is within sights now. We expect, because when you look at sectors like steel or aluminum, or all the commodity sectors, which are the larger capex sectors in any economy, all these companies have not done any capex for the last 5-6 years. Plus, demand has been growing by 5 to 8% every year. So capacity utilization for these companies have gone up significantly. Also, on the other hand, balance sheet leverage on all these companies, or debt on the balance sheet of these companies, have gone down substantially. What it tells you is that they are now, and whenever we look at any company in these commodity related sectors, they are all on the drawing board thinking of doing when to do the next phase of capex. I think within the next 2-3 years, you will see private capex, larger private capex picking up in a bigger way. Also, power sector, we are, though COVID did delay the recovery in the power sector, but I believe with solar, wind, alternative energy, the way it is growing, power sector growth will also happen. Telecom is now trying to repair its balance sheet with tariff increases and profitability and cash flows. Telecom capex will also start. So these larger ticket size capex, in our opinion, will restart. So it is within sights. So any cyclical economic upturn, today we are in early stage. When capex starts 2-3 years down the line, which is probably by 24-25 calendar year, you will be in a late stage of capex or economic upcycle. So from today, we are in 2021. I think we are in a cyclical upstage. We are at an inflection point. We will probably go on for the next 4, 5, 6 years. Probably could get extended given the levels of interest rate, monetary policy are being adopted by across the world by central banks. A lot of money supply flowing around. So that's the second important point that I want to highlight. Government is doing a decent job. They have preponed their large capex, dedicated freight corridor, and road projects. They are all being preponed and being done in the immediate term, which is this year and next year, and that is a good sign. And finally, another sign that I think is a very big positive, which is leading to deleveraging or reduction in debt in balance sheets of corporate India, is that in this budget, the finance minister or the government, in one stroke, cleaned all the dues that the government had towards corporates. So they cleared food corporation. They merged the food corporation balance sheet with the government in the fiscal deficit. They cleared all the fertilizer dues. They cleared all. So they've cleared most of the dues, which means that corporate India balance sheets are healthiest that we would have seen for many years. For example, corporate debt to GDP today is something like 12-13 year low. So that tells you the kind of extent of deleverage, and you can see it in the numbers in bank balance sheet as well. Credit growth is fairly low at 5-6%. Once capex starts picking up, the credit growth will also pick up. So these are the positives, which tells me that long term, and that's the headline that I have mentioned. Long-term market outlook looks promising, and one needs to look at the market in a favorable manner. These are decent times to continue to invest in the markets. Having said this, let me take you through some of the risks. The first is global central banks across the world, including India, have pump primed the economies. Interest rates are at an all-time lows. Bond yields are at a very low level. And at the same time, money supply in any economy that you look at, US, Japan, Europe, China, India, money supply at the highest, though the velocity of money is not so great, but that will pick up once capex starts picking up, once activity picks up. So money supply is very high. If there is any change in monetary policy or interest rates or money supply, it could have some impact on asset prices. Equity is also an asset class. We need to watch out for this. It doesn't look like anything is changing in the near term, which is the next 12-18 months. But this is something to be watching for. Second is COVID-induced lockdowns. This is an unknown. We are in phase 2. of COVID numbers increasing or patients increasing in India, this phase two, at least in my mind, looks scarier than phase one, because this time uh, probably, and as of now the data is looking good, but looks like mortality rates are increasing. And at the same time vaccinations are going on, so we'll have to kind of keep our fingers crossed and watch out this, because if COVID-19 induces another phase of lockdown, then it may impact asset prices. So this is something that we need to watch out for. And lastly, on risk side, though not very important risk, but it's still worth kind of mentioning, is that our starting point today, if somebody is investing today, is higher valuations. Now, our markets, for example, Sensex, Nifty, are trading at something like 20, 22 times 1 year forward. This is higher than normal. Normal is something like 16, 17, 18 times, 16 to 18 band. So we are something 20% higher than our normal levels. Even our premium, Indian market premium to other Asian emerging economies is also something like 25 to 30% higher than normal. So starting valuations are higher, though I did mention in my opening earlier remarks that we are in an early phase of earnings recovery. So once earnings grow, the valuations will start looking normalized. So that's the last thing, but it's a risk. What it tells you is that the next immediate 12, 18 months, given that we are starting with a higher valuations in the markets, maybe the immediate 6, 12 months returns, one should be cautious in expecting high returns. It may not be very high returns. It can still be 5 to 10%. This is just a number that I am throwing you. Don't take it as a guidance. But I would say that one should be cautious. The risk reward, in my opinion, is something like 1:1 or 1.5:1 at max. Earlier, a year back, I would have said 2 to 3:1. So that risk reward has certainly changed. So these are positives and some risks on the market that I thought I will start with, create a base for what I'm going to do next, which is to tackle on the indices or sectors, which is the topic of the day, where you can expect to make money. Though to start, before I go to sectors, let me make one point. Personally speaking, I would always prefer to recommend you all to look at diversified equity funds to invest in. Investing in pure sector funds or pure sector stocks is prone to risk. You need to enter and exit at the right time as well. Timing is important. Whereas when you invest in a diversified equity fund, then the fund manager does that job for you. So be that as it may, let me start with this slide. As you can see, I've kind of charted out which sectors have done how much or performed how well since FY11, and the first line is FY21. There are sectors like, though people have when they think about sectors today, people think about IT and pharma as sectors which have done very well. But surprise, surprise, sectors like commodities and industrials and auto actually did better than IT and pharma in the last 1 year. That's some food for thought for you. And interestingly, enough from my experience. So let me come. There are some reasons why commodities are doing well. How sustainable they are, difficult to say. But for example, today, what I see in commodities is that there is a very large supply constraint. Today, for example, most commodities, whether it is steel, copper, aluminum, nickel, anything that you look at, close to 50% production and demand or supply and demand is in China, one country alone. So any disruption that happens in China on account of production or demand tends to impact the whole world on commodity prices. In the last 12 months, post-COVID, China, for example, suffered from higher COVID patients initially before any other country had. They have been having supply issues and demand issues as well from time to time in the last 12 months. It's been a difficult world for businesses at least. Shipping rates have gone up. Container availability has gone down drastically in the world. So there are supply issues. Also, because of Chinese pollution issues, the Chinese government is clamping down on a lot of capacities in steel, for example, in aluminum, for example. They do not want any more or they do not want higher production growth in commodities. At least that's what the stated objective of the government is. And the resultant impact is that commodity prices, because China is no more a very large exporter of commodities in the world, and on the other hand, government like Indian government, for example, has put in anti-dumping duty or import duties on lots of commodities, including steel. We are seeing higher domestic prices or higher global prices of these commodities. And that is leading to, for example, just to put things in perspective, Q1 of FY22, the current quarter where we are in, the consensus that I was looking at expect all-time high EBITDA per ton or profit margins for steel companies in India. The last time we saw this kind of numbers were in FY08-09. This time, the profit margins are likely to be higher than that year. So that's the extent of price improvement or margin improvement that commodity companies are seeing, and which is being reflected in the stock prices in the last 12 months in these sectors. I have kind of tried to give my picks of sectors which I expect to do well going forward. This is necessarily not a one-year view. This is more like a 2-3 year view, and take it with a pinch of salt, bucket full of salt, because I'm biased, obviously. These are sectors where my funds or I am positioned to benefit going forward. So do your due diligence, do your research. But these are unlike FY21, where commodities, industrials, auto, IT, pharma were the leaders of the market. The next few years, I would say my bet would be on banks to start with. And this is in the order of preference, actually. Banks followed by manufacturing, telecom, commodities again, but selectively. And actually, I've also mentioned real estate. Interestingly, real estate actually not so much for the next 6-12 months, but more like 3-4 years. And I'll come to my reasons briefly. But banks especially, as I was explaining in my earlier remarks, in India, Indian banks have been writing off or providing for their gross NPAs since 2013. And they've been doing it for 7+ years, at least the corporate debt in a very big way. And when I look at or do a detailed analysis on banks' balance sheets on the loans that they've given onward to corporate India, and as I mentioned in my opening remarks, I did mention to you that corporate debt to GDP is at a 12-13 year low today. That tells you a story that corporate India is deleveraged aggressively. No corporate today talks of high debt. In fact, everybody wants to deleverage and become debt free. That's the trend that we are seeing from a listed company side. And that benefit, in my opinion, will come to banks in a very big way. We have already seen the benefit coming in, for example, during COVID times, at the first phase of COVID, which is between April to September of 2020, if you all remember, there was a very large fear that banks will see very high NPAs. But the reality is very different. Banks are delivering very high, very strong numbers because NPAs are not as high as people were fearing. And this trend, in my opinion, will continue. And credit growth in the next few years will also start picking up. Our return on equity delivery by banks will be better. And this is one sector in our market where valuations are attractive. Unlike all the sectors that you see in the markets today, banks is probably the only sector today where we can convincingly say that valuations are reasonable and there is room for upside in valuation. So, which is why both on earnings delivery and valuations, I believe banks would be my top pick for the next few years, not necessarily the next 12 months only. The next is manufacturing. India is not known for manufacturing, barring automotive, auto ancillary, and chemicals and pharma. There are some sectors where we have done well. Gems and jewelry and textiles were of the past. But we are not known for doing very high value-added manufacturing and exporting to the world. We've been manufacturing, but more like for India consumption. This year, FY21 is probably starting off a new trend. China plus one, this term probably you would have heard. China is a manufacturing hub for the world for most industries. We have started hearing this term for the last 12 months, increasingly more and more, and benefit is coming to India of China plus one, which is that globally sourcing is starting to shift, and it's just a starting phase, starting to shift from China towards other countries, including India. And with the measures that the government of India has taken from a production-linked incentive perspective, for example, electronic manufacturing, mobile phone manufacturing has already seen a very big booster in India. All our mobile phones today, for example, or at least in the next 1 year, 1.5 years, will be domestically sourced only, barring some equipments here and there. And obviously, it will take time for 100% indigenization. It may not happen, but from a 5-10% indigenization, we are going toward 25, 30, 35, 40%. So India is changing from a manufacturing perspective. We are also becoming an export hub for many commodities, many industries, for example. And PLI schemes or production linked incentives scheme announced by the government is a very welcome step for consumer durables, electronics, and now auto ancillaries and food processing, and so many things are being focused by the government, and the corporate India is kind of likely to benefit from that. So manufacturing is something that one needs to look at. It's a very wide segmented, it's a theme actually, and you need to identify the right stock in that theme. And as I've mentioned in my potential winners, I've also mentioned stock selection is the key. So you need to focus on the right business to buy. Not every company will benefit. So choose the right business and you'll benefit from that trend. Telecom and real estate are two sectors which I believe have the potential to deliver strong performance over the next 2, 3 years, 4 years. So I will keep my watch for these two sectors. And commodities, be very selective because commodities have already performed well in the last 12 months. So I would say that, but selectively, 1 or 2 companies or 1 or 2 segments of commodities can continue to do well from a return perspective. So these are my thoughts on sectors or which of the past and what can happen going forward as well. With this, I will pause and maybe I'll pass it on to Shikhar. Thank you.
Thank you so much. Yeah, thank you. Thank you so much. That was quite informative, especially given that with the rising number of cases, a lot of people, a lot of my own friends are also some of them are talking of waiting till the market reaches to the point where it was back in April 2020. They're thinking it's going to go down there. So, talks like this would be very insightful at this moment, because clearly they're not falling as sharply as they had last year. Thank you so much for that. All right. Hello, everyone. I will be talking about Groww, the service that we provide and the things that we offer. I'm mainly here to also take your questions about Groww, whatever questions you might have about what we offer, about Groww as a product, about our future roadmap, and so on and so forth. I will quickly start sharing my screen. Could you please stop sharing your screen?
Yeah, I've already done that actually.
Actually, yours. Oh, now it's gone. Cool. Thank you. All right. Great. So, as many of you know, signing up on Groww is very, very easy. It's very simple. It's all done remotely via your smartphone or laptop, and it's 100% paperless. Even if your KYC is not done, we'll get it done for you for free. When you log into your app, this is the screen you enter on, and this is what we call the Explore screen. So here you have stocks, mutual funds, and gold, 3 tabs. Each of these, you can see the Explore screen of that offering. So in case of mutual funds, you can see there's popular funds, there's collections. Likewise, if you go to the stocks Explore screen, you'll have market indices, top gainers, top losers, and so on and so forth as you scroll downwards. Likewise, if you go to gold, you see the gold offering. As of now, there's 1 gold offering, which is Augment Digital Gold, and we'll be adding other options in the future, though that's not a very urgent priority right now. This is what a mutual fund page looks like. So whenever you search or tap on a mutual fund's name, you end up on a page like this. And in this page, you will be able to find all possible information that you might want to know about a mutual fund. Like, for example, here, you can see the rating, you can see the NAV, you can see the fund size, You can also see other things like its past returns over different periods, its fund manager, how it compares with other funds from the same category, and I mean all possible details. What assets it has invested in. There's literally nothing that you as an investor should know and that you wouldn't find here. And likewise, we have a similar stocks page. So whichever stocks you search, you'll end up on a page like this, where you can see all details of that stock. And similarly, for our gold offering, you have a page for the digital gold offering, where you can see things like purity, carat, taxes applicable, etc. In our mutual funds, in any mutual fund for that matter, in most mutual funds rather, you can also do a one-time investment. It is not necessary that you do SIP or monthly investment. This is something that many users tend to mistake. It's not necessary that you invest every month. You can invest one time and not invest again. This is the dashboard. In the dashboard tab, again, you have the stocks tab, mutual funds, and gold. And each of these, you will have holdings that belong to you. You'll be able to see all your own holdings. So in case of mutual funds, you can see the mutual funds you've invested in, stocks, gold, so on and so forth. If you tap on any mutual fund's name, you'll get the option to invest more or redeem. And if you tap on more details, you'll be able to see a passbook-like arrangement where you can see all the times you've withdrawn, all the times you've invested, the average NAV value, your folio number, all possible details with your transaction in that specific mutual fund. Import and switch. So import allows you to get mutual funds that are not on Groww. Let's say you invested on some other platform via someone else and you want to move it to Groww. You can do that using the import option. So again, go to the dashboard, mutual fund dashboard, scroll all the way to the bottom and you'll see the import option. Again, it takes only a few minutes and it's completely paperless and you'll be able to see all your mutual funds in one place. So it's very convenient that way. And followed by that is followed by something called switch. Now, often when people invest on other platforms, they are investing in a regular plan mutual fund wherein they're paying some kind of a commission. And when you move to Groww, once you've imported them to Groww, you can easily switch them to the direct plan where there is no need to pay any commission. So first you import and then you switch them to direct. Groww Digest daily and weekly. So this is another one of our very popular offerings. You can visit the website groww.in/digest. Every day we send a digest in the evening. This also comes to your email if you're a registered user on Groww. And every week on Sunday, in the first half, we send a weekly digest. So the daily digest is designed to tell you about all the major things that happen in the day that you should know. It's a very low clutter digest where we only include what is absolutely essential. We try to keep it very simple. So reading a digest does not take more than a few minutes at max, not more than that. And likewise, the weekly one is a bit longer, but we try and that is aimed more towards making sure that our users are better informed. They're better investors. They learn better. They think fundamentally about investing and not just in technical terms. If you have any questions for us, please do write to us at support@groww.in, our email ID. And if you're stuck somewhere, if you need any help or support, you can also use our help and support option in the app and website, using which you have the option to raise a ticket, which allows you to call us, allows you to email us, or even chat live with us. Please follow us on Facebook, Twitter, LinkedIn, and YouTube. YouTube is something I feel many of you will especially like because we upload videos about investing there. And we were quite regular, around 3 videos per week at least. And it's more centered towards stocks, although we also cover mutual funds and other investment and personal finance related topics. So please do go and check out our YouTube channel. We've also launched many regional language YouTube channels. So that is also available if in case you're not, you want your content in a specific language. That's it. I come to the end of my presentation here. We will now take questions from every user. Yeah. Thank you.
Thanks, Shikhar. That was informative. And I think thank you, Mr. Prakash, for taking, I think, in such a simple language, you took us through what the market is currently planned and which all sectors are looking really positive. So this is the time when we take our questions from all our viewers, and there are a lot of people who have asked a lot of questions to our fund manager. So I think he mentioned about the banking sector clearly. It was right on the top of his wish list. I think somebody still wants to understand. I think you were very, very clear. But any other points you would like to add on the banking sector? Why somebody should put this into their portfolio for next few years?
Yeah, so maybe one is, let me reiterate that I do believe that at least I think that banks have, from a risk reward perspective for an investor over the next few years, I think banks make sense to me from an investment perspective. But maybe one point to add, which I did not add earlier, is since the question has come now again, is that if you look at the banking sector, what is interesting to note is that the top 4 or 5 banks or financial institutions, maybe I'll add one NBFC as well there, or HFC as well there, command the whole market today. They can make or break the market. In fact, I would go on to say that there is dearth of banks in India today. Demand supply mismatch is fairly high today, in the sense that demand for people who want loans is higher than what compared to the number of banks which can give loans, or institutions which can give loans. So there is this pricing power with financial institutions in the country today, and will probably remain for some time, till the time either some smaller banks become larger in size, or the PSU banks get their act together, or there are some new licenses which are given by RBI and new institutions come up. So it's a runway of higher. So unlike the global banking sector, where even if you notice, if you've looked at the historical numbers for global banks, very difficult for banks to deliver double-digit return on equity sustainably. Given the Basel III implementation norm, regulatory norm which have come up, very difficult to deliver high ROEs in the global system. Whereas our banks, because of the way this system is structured in favor of these banks, at least for the next 3-5 years, probably longer, banks will be, at least the top ones, will be able to deliver high double-digit return on equity profile with higher growth as well. And valuations today are reasonably reasonable. So it makes sense to invest, yes. Banks are one of my favorites today.
Sure, thank you on that. Sectoral investing, is it good for short term? And another question very related to this is, what percentage of sector allocation somebody can take in their portfolio? Is there any ballpark figure, or if it's depending to each portfolio?
So my personal opinion, as I said in my opening remarks as well, is that one should avoid investing in sectoral funds because you need to enter at the right time and exit at the right time as well. Because sectors go through, as we showed you, both Rishabh also showed you and I also showed in my presentation, the historical pattern of how sectors have performed. There are times when a sector doesn't perform. Let's take IT, which is a very common sector of discussion today nowadays, because that sector has been doing well. But there were years where in between, let's say, FY 15 to 18, where IT was not doing so well. Consumer used to do well at that time. Today, consumer is not doing so well, and commodities are doing very well. And as Rishabh showed you, a 15-year number where commodities have delivered very poor returns for such a long period of time, but there are phases where returns are very high, 100% plus, like last year. So I personally prefer investors to rather invest in diversified funds. But if you have to invest in sectoral funds, if you can choose your timing of entry and exit well, then yes, but keep it at a lower proportion of your total allocation. My personal opinion would be that anything below 25% of your overall allocation is okay. That much of risk you can take, but I would advise you to take Groww and their team's views as well, because they are the experts in identifying the right themes as well.
Great. So I think just to summarize what he mentioned is like you leave it onto the diversified fund manager and let the fund manager and his team take calls on sectoral, because they are more qualified and they are doing this day in, day out, and higher success rate would be there when compared to individually somebody is trying to work on these sectors. So that's very informative. And another viewer wants to know on the FMCG sector health, like how FMCG is currently poised, and somebody looking at long term, let's say 5 years plus kind of period, should he include FMCG in his portfolio?
I would think so. But again, before on the sector specifically, think about diversified funds first and then go to sector. But since the question is on that particular sector, I think so, yes. I think it's been a period of consolidation for the last few years on FMCG as a sector. It's before, but mind you, before FY19, FMCG sector has been back to back for 8-10 years, back to back strong performer. And what has happened is that earning growth for FMCG companies has been very steady at around 12 to 15% CAGR for the last 10 to 12 years. But valuations have moved significantly higher, and hence returns till FY19 for the last between FY09 and FY19, the average FMCG return, if I'm not wrong with my numbers, I need to check personally, but I think the returns were as high as 25% CAGR. So PE re-rating or valuation re-rating was very, very high in the FMCG sector. What we are seeing today in the last few years, earning growth is still sustaining, but valuation is consolidating. It's been a very strong performance, and hence it's just normal to assume that for some years, this sector may not contribute aggressively on return perspective. Having said this, the question was long term, that for the next 5-10 years, can we invest in this sector? I would say so, yes. Rishabh's chart, if you go back to that chart, the first slide actually, where he is explained, or one of the slides where he's shown 15 years performance of a sector, you would notice that consumer sectors, FMCG and consumer durable, come in the top of the chart over long periods of time. The reason is that these are steady, sustainable growth companies. So the longer you hold this sector, the better it is.
Great. Another one question is on infrastructure, especially after the budget, the boost which the finance minister wanted to give to infrastructure. What's your view? Has it already started, and can we see more traction on the infra theme going forward?
So I think it's already started. Yes, it started, and infra spending, in my opinion, will continue going forward. What is also interesting to note is that the government has. So in the past, there have been concerns that the government doesn't have enough money to spend. And what was happening earlier is that the government used to incentivize private sector to come in and spend, create BOT assets, build on operate assets, own the assets, and transfer it to the government at a later date, 20, 25, 30 years later. So the private capital was supposed to take the risk. But as we all know from experience, and banks are seeing the adverse effects of private capital not doing so well on infrastructure. They are all stuck because of land acquisition, environmental norms, and all those issues of the past. So infra stocks have not done well, and banks have also suffered because of that. I would say that phase is changing, because what is interesting to note is that the government has realized that they have to invest. Now, government budgets don't allow them to invest aggressively. So what they are doing now, and FY22 will be the first year of that happening actually, is that they are now looking to come up with InvITs, infrastructure InvITs, where they will list those InvITs, they will give some portion of the assets. For example, NHI is going to do that, Power Grid is going to do that. So they will get money upfront from the investors, and that money they'll use to either at least they'll invest again in the power side or road side. So it's an interesting way to fund your future infrastructure capex. So I think, yeah, it's happening. It's a gradual phase, but yeah, we have started on that journey. And as I was mentioning in my own slide, I said that government has preponed some of the infrastructure capex this year and the next year. So that way you will also see. And lastly, by next year or the year after, maximum by FY24, dedicated freight corridor will be fully commercialized. We've been spending, the government has been spending on that, on dedicated railway corridor to take freight from the west to east and north to west. These are the two routes which are going to be operational very soon. That will save a lot on freight cost for the corporate sector as well. So we are going to see a lot of benefits which will come up in the next few years from all the investments that are happening. So I think, yeah, it's happening. But stock returns don't link with infrastructure investment to stock returns. Stock returns are very different. My personal view is that infrastructure stocks are cyclical stocks. You need to be very choosy, one, and two, time your entry and exit also perfectly well, because there are times when they do not do well as well. So, infrastructure investments will happen, but stock return may or may not happen.
Yeah, I think that's a good disclaimer which you mentioned, because a lot of time people feel that infrastructure is doing so well. So obviously the returns from my infrastructure fund should also go hand in hand, which may not happen, which we have seen in the past as well. Shikhar, there's one question somebody wants to know, is Groww available on iOS as well?
Yeah, we are obviously. I think a big chunk of our users are on iOS, and yes, I'm surprised you had troubles. Actually, maybe it's because you're in a country. If you're not in India, you might be in some other country. Not every country has access to Groww, because Groww is an Indian product and it is relevant to Indian investors. We don't support NRI investors. So maybe that is why, if you're trying to access this app in a foreign country, you might not be able to find it, even on Android. That's true for iOS and Android. So yeah.
Great. Another question. I think last year we saw a lot of IPOs hitting Indian bourses. So do mutual funds invest in IPOs? And if yes, then what are the criteria they generally look before investing?
So yeah, the good thing about the IPO system today is that all IPOs need to necessarily allocate some portion of their capital to mutual funds. And hence mutual funds are a very integral or important part of any new IPO. Having said this, we do invest. So as a mutual fund, generally as a mutual fund, and Tata Mutual Fund in specific, we do invest. However, recent times, since we've seen a lot of IPOs in the recent times, I would say most IPOs, if not all, most IPOs are coming at very aggressive valuations. And on top of aggressive valuations, because of the way markets are, stock prices were shooting up on the day of the listing, And at least from our side, we have participated in some IPOs and benefited from them, but not all of them. So one needs to be very choosy. And the second part of your question was, what do you look at? Well, it's the same for listed companies and IPOs both. You need to look at profit, growth, what are expectations built into the stock price, what valuations does the company generate, free cash flow, how sustainable is it, all those parameters, management quality, scalability of the business over the long term, all of those things will apply to IPOs as well, which we look at before investing.
Great. Another question is on the electric vehicles. So a lot of buzz we are hearing on EV and how it will change the dimension for the auto sector. So can you throw some lights on what is poised for auto sector with this new thing coming into our industry? How will it benefit the existing sector, or it will impact? What is the way forward in this space?
So from an India EV perspective, world is different, India is different in the sense that from an India EV perspective, we are still in early days. I would say at least two-wheelers is the segment where, and buses are two segments where electric vehicles are kind of penetrating more than normal. But it's still early days. We don't have charging infrastructure enough. We don't have our models in place in the sense that we are from an infrastructure availability perspective, every state, every city is thinking differently. State governments are thinking differently. Center is thinking differently. There is no common, so policy related clarity. So for companies to start investing aggressively is still remaining. The second part, which is important point in my opinion, is that economic models for businesses to scale in EVs, electric vehicles, is still not certain. We do not yet, at least in our mind, when we look at business models of businesses who are looking at electric vehicles, they do not have a business model in place to make money. Ultimately, businesses are there to make money from consumers. On the one hand, electric vehicle is costlier than a normal ICE engine vehicle, which means that a consumer has to pay higher in spite of subsidies that the government gives. And two, at that high price, even when a company sells a vehicle, do they make money or not? So that's a question mark in our mind, at least at this point in time. So these are early days, as I said. Ultimately, we'll have to watch this space. It is promising. Yes, this space is promising. It has large implications for the auto sector. For example, the biggest one is for auto ancillaries. India is a very large hub for auto ancillaries globally. An electric vehicle requires probably 20% of auto ancillaries which a ICE engine requires. So there will be a lot of disruption actually once ICE or electric vehicle becomes a reality, if at all they become a reality. So these are some things to watch out for, but as of now, it is early days.
Thank you so much, Mr. Chandraprakash, for those insights. I think that was the final question for the today's session. And I think our investors have a delight with so much information getting in 1 hour in terms of various sectors, though our fund manager gave a clear disclaimer that make sure your portfolio is diversified. And when you are taking sectoral bets, your timing is very, very crucial. So please keep that in mind and invest. So thank you so much, Mr. Chandraprakash and Shikhar, for joining with us and giving your insights and taking us through the Groww app. It was an insightful session. And again, next week, we will come along with another interesting topic and another interesting personality from the industry. So till then, stay safe, stay healthy, and goodbye.
Thank you.